All right, let's jump right into this explainer. We're going to completely demystify the everyday digital banking tools you're probably using all the time, but might not fully understand. We all tap, swipe, and transfer money daily, sometimes way faster than we can earn it, right? Yet, the complex digital systems working tirelessly behind the scenes often just feel like this giant alphabet soup of confusing acronyms. Have you ever actually wondered what happens in those few milliseconds between hitting send and the money popping up in someone else's account? Well, it's definitely not magic. It is a highly orchestrated symphony of digital signals. So today we're going to break all of that down so you know exactly how your money is moving.
Here's a quick look at our roadmap. We'll start with 1, the digital banking revolution. Then move to 2, why e-banking matters. Next is 3, EFTs explained, followed by 4, NEFT, RTGS, and IMPS. And finally 5, the fintech disruption.
A lot of people just assume banking naturally evolved alongside the internet. We often think traditional banks just woke up one day and decided to build slick mobile apps because it seemed like a fun, modern thing to do. But history tells a very different story. So let's start with a pretty provocative question about the real, highly unexpected catalyst for this massive global shift. What actually forced an ancient industry, one that had been doing things the exact same paper-based way for literally centuries, to suddenly digitize?
Section 1. The Digital Banking Revolution.
The real turning point here is the 2007 to 2009 global financial crisis. Before this moment, retail banks essentially relied on massive stone buildings and heavy steel vaults to project this image of absolute, untouchable security. They were highly secure, wildly profitable, and honestly pretty much unchallenged. But the crisis changed absolutely everything overnight. It resulted in these massive institutional losses and completely shook worldwide consumer trust right to its core. When traditional banks almost collapsed, customers suddenly realized their hard-earned money wasn't just sitting safely in a physical vault somewhere. To prevent the massive panic and an exodus of clients, banks realized they couldn't just lean on their centuries-old reputations anymore. They had to pivot, and fast. This profound lack of trust, combined with the sudden desperate need to aggressively cut overhead costs, literally forced the rapid integration of technology into all spheres of banking. They had to offer radical transparency and convenience, or they were for sure going to lose their customers forever.
And that basic human desire for ease of doing business, specifically widespread customer dissatisfaction with traditional service, became the primary driver pushing banks toward anytime, anywhere access. Think about what banking used to require: taking time off work, standing in these endlessly long physical lines, dealing with heavily restricted branch hours, and meticulously filling out paper deposit slips by hand. It was just incredibly high friction. Not happy with the services basically became a global rallying cry. Consumers demanded better, and it was this vocal frustration that genuinely forced financial institutions to entirely reimagine how they interacted with us, stripping away all that friction of physical banking in favor of immediate digital gratification.
Which brings us to Section 2, why e-banking matters.
Let's ground ourselves with a super clear definition here. Electronic banking, or e-banking, is basically the invisible exchange of electronic signals that moves money directly between accounts without any physical paper. I really want to emphasize that last part. No cash, no checks, no manual ledgers. The whole shebang is a seamless system built entirely on rapid data transmission across highly secure networks, letting funds shift instantly from one institution to another in mere milliseconds. We are essentially transforming physical labor and physical currency into pure data, which effectively makes geography completely irrelevant to your personal finances. And this massive shift fundamentally altered the entire competitive landscape. Traditional branch models, which are weighed down by super expensive real estate and heavy staffing costs, are now fiercely competing with web-only modern digital-first banks that operate entirely online. Because these digital banks, like E*TRADE Bank for instance, don't have to pay for thousands of physical brick-and-mortar locations, their overhead is drastically lower. They take those massive savings and use them to offer integrated ATM access, significantly lower fees, and much higher interest rates straight to the consumer. Traditional banks had to radically increase their pace of digital adoption and slash their own operational inefficiencies just to stay even remotely relevant against these lean, aggressive innovators.
By cutting those huge physical overhead costs, banks were suddenly able to offer some incredible, frankly, life-changing benefits to everyday consumers. We're talking true 24 hours a day, 365 days a year access. It fundamentally changed how we manage our finances, giving us total control from our office, our couch, or our smartphone, no matter the time zone. Plus, and this is kind of a fun fact, this instant access inherently promotes really powerful financial discipline and deep transparency. Think about it. When you can instantly check your exact balance on a smartphone before making a purchase, you're way less likely to overspend, compared to the old days when you had to wait weeks for a printed monthly statement to show up in the mail. Technology is actually helping us keep our financial house in order.
All right, Section 3, Electronic Fund Transfers Explained.
At the absolute heart of e-banking is the EFT, or Electronic Funds Transfer. Whether you're grabbing emergency cash out of an ATM at midnight or buying international stock over the phone, you're utilizing an EFT. It is a remarkably complex digital system designed to completely eliminate geographical barriers, allowing you to move money globally without any direct intervention from bank staff whatsoever. Just think about the sheer technological leap this represents. Millions of microtransactions are happening simultaneously all around the world, completely automated and totally free from human error or manual processing delays.
But, as you can imagine, total automation strictly requires total precision. To actually initiate an online transfer, the remitter, that's you, the sender, is solely responsible for providing highly specific, perfectly accurate details to the digital network. You need the beneficiary's name, their exact account number, and their bank's name. But most importantly, you absolutely need the IFSC code. That stands for Indian Financial System Code. This unique 11-digit alphanumeric string acts exactly like a highly precise GPS coordinate for your money. It identifies the exact specific receiving branch anywhere in the country, so your data packet and your funds are routed securely and don't accidentally end up in a total stranger's account.
Let's dig into the specific tools. Section 4, NEFT, RTGS, and IMPS.
Consider this your ultimate financial cheat sheet. It breaks down exactly how these three incredibly robust back-end systems, NEFT, RTGS, and IMPS, differ from one another based on processing speed, daily transaction limits, and overall availability. You'll want to keep this structure in mind because choosing the right system depends entirely on how much money you're sending and exactly how fast it absolutely needs to get there. Understanding this really matters to your wallet. If you use the wrong system for a super urgent Friday afternoon payment, your funds might not actually clear until Monday morning, which could lead to missed deadlines, annoying late fees, or bounced checks.
Let's start with NEFT, the National Electronic Funds Transfer. The crucial thing to understand about NEFT is that it operates on a deferred settlement basis. This means it doesn't process your transaction the exact millisecond you hit the send button. Instead, the central banking system groups thousands of transactions together and processes them efficiently in timed batches. Why do banks do this? Well, processing in batches drastically saves on server load and back-end bandwidth. By reducing that digital strain, banks can keep transaction fees ultra-low or even totally free for the consumer. Because of this high reliability and the fact that there's no minimum limit, this batching system is exactly why large companies almost always use NEFT for processing your monthly salary transfers.
Now, what if you're buying a house, securing a massive business deal, or moving serious capital that simply cannot wait? Unlike NEFT's waiting game, RTGS, Real-Time Gross Settlement, processes everything on an immediate, real-time basis. When you hit send, the money moves instantly. But there's a significant catch to this premium speed. It requires a minimum transfer of 2 lakh rupees, and it typically operates only during standard banking business hours. This is the absolute heavy lifter of the banking world. It's a highly specialized tool designed specifically to handle massive, high-value transactions where immediate confirmation is legally and financially critical.
But for practically everything else in your daily life, there is IMPS, the Immediate Payment Service. Honestly, think of IMPS as the absolute superhero of modern daily banking. It allows you to instantly split a dinner bill with friends or send emergency cash to a family member using just a mobile phone or a mobile money identifier, also known as an MMID. There's no minimum limit, and the true beauty and power of IMPS is its relentless availability. It works flawlessly 24 hours a day, 7 days a week, 365 days a year. Whether it's a Sunday night or a national bank holiday, IMPS guarantees your funds move at the exact speed of your modern life.
Which leads us to our final point, Section 5, the FinTech disruption.
Notice how it all seamlessly comes together here. Those fundamental back-end transfer methods we just broke down, they paved the way for an unprecedented era of disruption.
Agile fintech startups like Paytm, PhonePe, and Google Pay didn't actually invent entirely new underlying banking networks. Instead, they really cleverly utilized those robust back-end systems, specifically by integrating with brilliant API layers and innovations like the Unified Payments Interface, or UPI. UPI acted as the ultimate digital bridge between clunky, old banking infrastructure and modern, sleek, incredibly user-friendly mobile apps. By building these intuitive apps on top of existing bank rails, these startups basically forced established, deeply traditional banks to drastically speed up their own digital adoption just to prevent a massive loss of clients.
Because of all this, we've officially entered a completely new banking frontier. For the first time in human history, physical cash has been completely overtaken by digital and card payments. We now rely heavily on smartphone banking apps, advanced check imaging technology where you can literally just snap a quick photo on your desk to deposit a paper check, and even seamless smartwatch banking integration. And here is a truly counterintuitive insight. Taking the physical human interaction out of banking and digitizing our cash has actually given us a closer, more immediate, and way more transparent relationship with our personal finances. Think about it. A gentle haptic vibration and a push notification on your smartwatch creates infinitely more daily financial awareness than a massive, confusing paper statement arriving in the mail once a month ever did.
So as we look at how incredibly far we've come since the dark days of the 2008 financial crisis, evolving from a terrifying loss of global trust to a hyper-connected world where we can securely move money across borders with the simple tap of our watch, it leaves us with one truly fascinating question to ponder. With advanced boundary-pushing technologies like distributed ledgers, blockchain protocols, and virtual currencies rapidly looming on the horizon, what unimaginable technology is going to completely reshape our finances next? Keep that profound evolution in mind the very next time you seamlessly split a dinner bill with a friend. Thank you so much for joining me on this explainer, and keep learning.